When discussing personal finance and arriving at the topic of debt, people often proudly say, I don't have any debt, only the mortgage. Although we acknowledge that the mortgage does belong on the liability side of the balance sheet, this statement suggests that many of us mentally split them into two camps: good debt and bad debt. We may also feel ashamed or embarrassed about being in debt at all, stemming from a regretful family history or from what we've heard from various financial media sources claiming all debt is bad. Whether we believe good debt versus bad debt is an accurate, healthy framework or not, we can break down their defining characteristics for a more thoughtful approach to debt management. When we finance something, we typically want the benefit of the purchase to last longer than the debt repayment period. Mortgage, small business, and student loans often fall into this category, whereas a restaurant meal, which may only provide beneficial energy for half a day, may result in a credit card balance over multiple months. Are you currently making debt payments for something that's no longer serving you? And next, when we purchase something with debt, we want its value to appreciate over time, leveraged with a higher expected investment return than the loan's interest rate. We may consider an affordable mortgage for a primary residence or rental property, student loans with future earning potential that outweighs the total expenses, or responsible small business loans to accelerate revenue growth. On the other side, we don't want the debt repayment period to last longer than the benefit, for the asset's value to depreciate, or for the loan's interest rate to be greater than the expected return on investment, whether that return is quantitatively or qualitatively defined. Credit cards that carry ongoing balances and high interest auto, payday, and retirement plan loans fit these characteristics. During this video lesson, we are going to review a credit card statement, including how to look beyond the numbers and discover opportunities to have deeper conversations with your family, if that applies to you. Even if you pay off your credit card balance in full every month, I encourage you to download your most recent statement and follow along. Starting at the top, the statement will include the partial account number, which you may include on your balance sheet. Next are the billing cycle dates, the balance as of the statement closing date, and the minimum payment with its listed due date. In this case, Susan is charged a minimum payment floor of $25, but this minimum payment could be a fixed 2 to 4% with a higher balance. You will also find a late payment warning and a minimum payment warning, which are legally required to state the total time and interest payments required to pay off the balance in full if only making minimum monthly payments. The credit card's interest calculation is determined by the daily balance method and shows the variable annual percentage rates, APRs, per balance type, whether for purchases, cash advances, or balance transfers. These rates typically fall between 15 and 30%, with higher percentages for cards with promotional periods. This high interest unsecured debt often deserves prioritized repayment because it's nearly impossible to experience investment returns that high, especially from anything you can purchase with a credit card. When you have more than one source of debt, such as credit cards, private student loans, a mortgage, and an auto loan, there are a handful of popular methods to consider when prioritizing your debt repayment order of operations. There's the rational debt avalanche method, paying off the highest interest rate debt first to reduce the total payments. The reasonable debt snowball method, paying off the lowest balances first with psychological momentum, and hybrid methods based on debt to interest or debt to monthly payment ratios. Although the second debt snowball method may provide shorter term rewards, if someone has the discipline or accountability to implement any of these methods with intention, I prioritize the debt avalanche method using the free online debt repayment tool I've linked below. Keep in mind that all of these debt repayment methods assume you continue making minimum payments on the debts you're not aggressively prioritizing, avoiding penalties along the way. The most significant issue I've observed with debt repayment is being rational with the decision making, but irrational with the implementation. It feels good to select the best method for you, but the actual repayment and its monitoring needs to be just as intentional. You need to know what to do, how to do it, and why your action aligns with your unique values and desired outcomes. If you need help with ongoing accountability, I recommend you hire a professional financial coach. I've shared a link below to help you find a financial counselor who specializes in the fundamentals of cash flow and debt management, if that applies to you. Moving to the credit card statement's account summary, we view the general transactions over the given period, including any payments, credits, purchases, fees, and interest charges. Each category is included in greater detail as you move down the statement. It's a great sign to see no interest charges during this billing period. Next is the total credit limit versus available credit for this card, giving us a glimpse of the credit utilization factor, dividing the current balance into the total credit limit, only 2.5% in this case. As listed on the account summary as other credits, this credit card offers cashback rewards between 1% and 10%, depending on the spending category. Other cards may offer travel miles with a similar summary, points earned and redeemed during the period. Assuming you pay off your credit card balances in full each month and have an intentional spending practice, you can search for various credit card promotional offers and rewards for your preferred spending categories. Moving down to the individual transactions, this is where the fun really begins. Since physical, mental, spiritual, relational, and financial wellness are interrelated, spending can reveal unique insights into what provides value to you and your family. And although some credit card statements include a breakdown of spending categories, I prefer to review them individually. Also, the spending categories are often organized incorrectly. By reviewing Susan's example purchases, we immediately notice some opportunities to dig deeper. They subscribe to a monthly streaming service within the entertainment category. Then, considering food purchases, we see they spent $259 on groceries and $67 eating out at Tostado's Mexican Grill, which is in their hometown. Considering that Susan visited this restaurant twice in one period and the purchase amounts were identical, this could indicate they appreciate routines and consistency. If someone reviewed your spending transactions, would they accurately guess what you and your family value? Seeing this transaction at Healing Hands Massage could indicate Susan's intentional focus on self-care and relief from stress. How does your spending of time, energy, and financial resources uniquely support your physical and mental health, spiritual practices, and relationships? Once you've reviewed your debt statements, you can also request your credit history from 3 nationwide credit reporting agencies: Experian, TransUnion, and Equifax. I recommend annualcreditreport.com for free reports and creditkarma.com for credit scores. The credit report will include your current and previous addresses, phone numbers, employment history, account information, payment history, and contact information for credit cards, real estate loans, and installment loans that have been reported to the credit bureaus from your creditors. Credit reports also include a key for multiple ratings and remarks, including current or late payments, repossession, foreclosure, voluntary surrender, refinance, transfer to collections, and others. And lastly, you'll find soft and hard credit inquiries and public records regarding legal matters such as bankruptcies, tax liens, and monetary judgments. From a technical perspective, you can review your debt statements considering the 5 categories of credit data used to calculate the FICO score: payment history, amounts owed, length of credit history, credit mix, and new credit, which are available in greater detail on the credit reports.